Most retail traders find themselves constantly battling against an invisible force, often losing money as they try to navigate markets seemingly controlled by unseen hands. This invisible force is what's commonly referred to as smart money, the large institutional players whose actions dictate price movements. In the volatile and rapidly evolving markets of 2025, understanding and aligning with these powerful participants is not just an advantage, it's a necessity for survival and success. Richard Wyckoff's method, a time-tested approach developed over a century ago, provides a profound framework for deciphering market cycles and the intricate maneuvers of these institutional giants, remaining remarkably relevant today. This simplified understanding of Wyckoff's smart money strategy is designed to equip beginners with a significant edge, transforming how they perceive and interact with the modern financial landscape. At the core of Wyckoff's methodology lies the concept of the Composite Man, or smart money. Wyckoff theorized that all price movements on a chart should be viewed as if they were orchestrated by a single powerful entity, the Composite Man. This entity represents the collective actions of large institutional investors, hedge funds, and other influential players who possess the capital and resources to manipulate prices to their advantage. They don't just react to the market. They actively shape it, accumulating positions quietly before a rally and distributing them strategically before a decline. These sophisticated players leave distinct footprints on the charts, not through explicit signals but through the patterns of price movement and trading volume. By learning to read these footprints, retail traders can effectively anticipate the Composite Man's next move, rather than being caught off guard. This fundamental principle liberates traders from the illusion of random market behavior, revealing an underlying order driven by calculated institutional actions. Understanding this, a beginner can begin to see the market not as a chaotic mess, but as a carefully choreographed dance where the Composite Man leads. This perspective shift is crucial, as it moves the focus from chasing fleeting indicators to understanding the fundamental supply and demand dynamics engineered by the market's biggest players. Without this foundational understanding, any attempt at trading is akin to playing a game without knowing its rules or who the real opponents are. Wyckoff showed us that the market is not a democracy, but rather an arena where the powerful exert their will, and our job as retail traders is to recognize and ride their coattails. Wyckoff further distilled market behavior into 3 universal laws that govern price action, providing a robust analytical framework. The first is the law of supply and demand. This law states that prices rise when demand exceeds supply, and they fall when supply outstrips demand. When there's a relative balance between buyers and sellers, prices tend to move sideways, forming trading ranges. This might seem simplistic, but its application within Wyckoff's framework is profound. It's not just about obvious surges or drops. It's about detecting subtle shifts in this balance within specific market phases. For instance, during accumulation, the Composite Man is absorbing supply, gradually shifting the balance towards demand, even if prices aren't immediately soaring. During distribution, they are offloading supply, paving the way for a downturn. The second law is the law of cause and effect. This principle posits that every significant price movement, the effect, has a preceding phase of accumulation or distribution, the cause, that determines the magnitude of that movement. A prolonged period of accumulation, where the Composite Man is patiently building a large position, will typically lead to a substantial markup phase. Conversely, an extended period of distribution will likely result in a significant markdown. This law teaches patience and foresight. The longer the cause, the trading range, the greater the potential effect, the subsequent trend. It encourages traders to look beyond immediate price action and understand the underlying forces building up. The third law is the law of effort versus result. This law involves comparing the trading volume, the effort, with the resulting price movement, the result, to gauge the strength of a trend or signal a potential reversal. If there's high volume, significant effort, but little price movement, poor result, It suggests that the composite man is actively engaged in buying or selling into that effort, absorbing the opposing pressure. For example, if prices are rising on decreasing volume, it suggests a lack of buying interest, indicating weakness. Conversely, if prices are falling on heavy volume but failing to make new lows, it indicates strong buying effort absorbing the selling pressure result. Divergences between volume and price are often early warnings of a change in direction, allowing astute traders to anticipate shifts before they become obvious to the broader market. These three laws, when applied diligently, provide a comprehensive lens through which to interpret market action, moving beyond superficial price charts to the underlying mechanics of institutional trading. To truly master the Wyckoff method, it's essential to immerse oneself in its foundational texts. For those looking to deepen their understanding directly from the source, Richard Wyckoff's own adapted edition of How I Trade and Invest in Stocks and Bonds is an invaluable resource. This classic work provides a direct insight into his analytical methods and decision-making processes. It's not just a historical document, it's a timeless guide that clarifies the very principles we're discussing, the nuances of supply and demand, cause and effect, and effort versus result. If you're serious about trading with the smart money, understanding Wyckoff's original insights articulated in his own words can provide a clarity and depth that no secondary interpretation can fully replicate. This book will help you connect the dots between theory and practical application, showing you how to build a robust trading framework based on proven principles. You can find more details and a link to this essential reading in the description below. Wyckoff observed that markets move in 4 predictable phases that continuously cycle: accumulation, markup, distribution, and markdown. Understanding these phases is critical to trading in harmony with the composite man. The accumulation phase typically occurs after a prolonged downtrend, where prices have fallen significantly. During this phase, the composite man quietly and systematically begins to buy assets from discouraged sellers, absorbing supply within a relatively tight sideways trading range. This is a period of smart money buying, often characterized by decreasing volatility and increasing volume on down moves as sellers are met by buyers, and increasing volume on up moves as buyers test the waters. The goal is to accumulate a large position without driving the price up prematurely. Key events within this phase, which we'll detail shortly, signal its progression. Following successful accumulation, the market transitions into the markup phase, also known as a bullish trend. Here, demand clearly overtakes supply, and prices begin to rise, often accelerating after breaking out of the accumulation range on significant volume. This is where the composite man's accumulated positions start to pay off, as the general public and trend-following traders jump in, fueling the upward momentum. This phase is characterized by higher highs and higher lows, with strong up moves on high volume and shallow, low volume pullbacks. Eventually, after a substantial markup, the market enters the distribution phase. This phase is the inverse of accumulation. Here, the composite man begins to sell off their accumulated positions to the eager public, who are often buying into the euphoria of a strong bull market. Prices move sideways within a trading range, but this time, the institutional players are strategically offloading their shares. Volume analysis is crucial here. Strong upthrusts often occur on lower volume, indicating a lack of genuine buying interest, while down moves might see increased volume as supply enters the market. The goal is to distribute positions without causing a panic sell-off prematurely. Once distribution is complete, the market enters the markdown phase, or a bearish trend. Supply overwhelmingly dominates demand, and prices begin to fall, often breaking down from the distribution range with heavy volume. This is where the composite man has successfully exited their positions, and the market is left to correct. This phase is characterized by lower lows and lower highs, with strong down moves on high volume and weak low volume rallies. It's important to note that these cycles are not always linear. Reaccumulation. Phases can occur within an uptrend, serving as pauses where the Composite Man adds to their positions before the trend continues. Similarly, redistribution phases can occur within a downtrend, allowing the Composite Man to offload any remaining positions, or even initiate new short positions before the downtrend resumes. These rephases are crucial for understanding the continuation or temporary pause of existing trends, adding another layer of sophistication to Wyckoff's cyclical view of the market. Recognizing these phases is the first step towards aligning your trading decisions with the dominant market forces, allowing you to ride the waves of institutional money rather than being crushed by them. Identifying the footprints of the smart money requires a keen eye for specific events and patterns within the accumulation and distribution phases. These events are not random. They are the deliberate actions of the Composite Man, leaving clues on the price and volume charts. Let's break down the key events in each phase. In the accumulation phase, we look for preliminary support, PS. This is one of the initial signs of demand appearing after a significant decline. The downward movement slows, and there's often a noticeable increase in volume, signaling that large players are starting to step in and absorb selling pressure. It's not a reversal, but a hint that selling is becoming exhausted. Selling climax, SC. A dramatic event characterized by a sharp drop in price, often accompanied by extremely high volume. This is typically a period of panic selling by the public where weak hands capitulate. Crucially, the Composite Man absorbs this massive influx of supply, buying aggressively into the fear. The SC often marks the extreme low of the trading range. Automatic rally, AR. Following the SC with the intense selling exhausted and smart money buying complete, the market experiences a natural bounce as demand temporarily overwhelms supply. This rally helps define the upper boundary of the accumulation trading range. The high of the AR is often used to draw the resistance line for the range. Secondary test, ST. After the AR, the price typically retreats to retest the area of the SC. This retest usually occurs with much lower volume than the SC, confirming that the selling pressure has significantly diminished. A successful ST where the price holds above or at the SC level validates the strength of the earlier smart money buying. There can be multiple STS within the accumulation range. Spring or shakeout. This is a crucial event, often occurring later in the accumulation phase. The price briefly dips below the established support level of the trading range, creating a false breakdown. This move is designed to shake out any remaining weak hands, retail traders with stop losses below support, and to trap bearish traders. Crucially, the price then quickly reverses and moves back into the trading range, often on increased volume. The spring is a powerful signal that accumulation is nearing completion and the market is ready for a markup. It's the Composite Man's final test of supply. Sign of strength, SOS. A strong move upward, often breaking above a short-term resistance within the accumulation range, accompanied by high volume. This confirms the bullish momentum and indicates that demand is now clearly in control. An SOS often follows a spring and signals that the market is preparing for the markup phase. Conversely, in the distribution phase, we look for inverse events. Preliminary supply, PSY. The first significant signs of selling appearing after a prolonged uptrend. The upward momentum begins to slow and volume might increase, indicating that the Composite Man is starting to offload positions. Buying climax, BC. A final euphoric push upwards, often on very high volume. This is typically driven by intense public buying, FOMO, where the Composite Man is aggressively selling into this demand. The BC marks the extreme high of the trading range. Automatic reaction, AR. A sharp pullback after the BC as the strong buying interest fades and supply temporarily overwhelms demand. This reaction helps define the lower boundary of the distribution trading range. Secondary test, ST. The price rallies to retest the area of the BC, but typically on lower volume, indicating weak demand. A failed ST where the price cannot sustain the rally or breaks below the BC level confirms the presence of supply and validates the earlier smart money selling. Upthrust, UT, or upthrust after distribution, UTAD. This is the bearish equivalent of a spring. The price briefly moves above the established resistance level of the trading range, creating a false breakout. This move is designed to trap bullish traders who buy the breakout and to allow the Composite Man to sell more positions at higher prices. The price then quickly reverses and moves back into the trading range, often on increased volume. The UTAD is a powerful signal that distribution is nearing completion and the market is ready for a markdown. Sign of weakness, SOW. A strong move downward, often breaking below a short-term support within the distribution range, accompanied by high volume. This confirms the bearish momentum and indicates that supply is now clearly in control. ASOW often follows a UTAD and signals that the market is preparing for the markdown phase. Last point of supply, LPSY. These are weak rallies within the distribution range that fail to reach previous highs, occurring on low volume. Each LPSY indicates that the market is progressively weaker and unable to generate significant demand, confirming the dominance of supply. Analyzing volume is paramount in all these observations, acting as the ultimate indicator of smart money actions. Volume confirms price movements. Strong price movements, whether up or down, should ideally be accompanied by strong volume to be considered genuine and sustainable. A rally on low volume is suspect, indicating a lack of conviction. Conversely, a decline on low volume in an uptrend suggests a healthy pullback without significant selling pressure. Culminating volume, such as that seen during a selling climax or buying climax, often marks significant turning points as the Composite Man executes their largest transactions. Low volume on pullbacks in an uptrend or rallies in a downtrend is generally healthy, showing a lack of opposing pressure. Most critically, volume divergences are powerful early warnings of potential trend reversals. For example, if a market is making new highs but on progressively lower volume, it suggests that fewer participants are willing to buy at those higher prices, indicating a diminishing demand and potential for reversal. Similarly, if a market is making new lows but on decreasing volume, it might suggest that selling pressure is exhausting, paving the way for a bounce or accumulation. Learning to read these interactions between price and volume is akin to understanding the hidden language of the market, allowing you to see beyond the surface and anticipate the Composite Man's intentions. For those fascinated by the historical context of these market behaviors and the individuals who shaped Wall Street, the YouTube channel Wall Street Memoirs offers a compelling dive into the very fabric of financial history. Just as Wyckoff meticulously observed market cycles and the actions of the Composite Man, Wall Street Memoirs chronicles the historical events, financial crises, and the lives of the prominent figures who navigated and often manipulated these markets. Understanding Wyckoff's principles becomes even more vivid when you see them play out in real historical scenarios. This channel provides a rich backdrop to the timeless truths of market dynamics, showing how the smart money has always operated, from the panics of old to the modern era. It helps connect the theoretical understanding of Wyckoff to the real-world consequences and the enduring human element of finance. Delve into the narratives that illustrate the very nature of market manipulation and the pursuit of wealth, just as Wyckoff sought to demystify it for the average trader. You can find a link to Wall Street Memoirs in the description to explore these captivating stories further. Now let's bring the Wyckoff method into the practical realm for beginners in 2025. Applying these complex principles requires a structured approach. Wyckoff himself outlined a 5-step approach to market analysis and trade selection. 1. Determine the market's current position and probable future trend. Is the market in accumulation, markup, distribution, or markdown? What is the overall bias? This involves analyzing broader market indices and sectors. 2. Select stocks that are in harmony with the general trend. If the broad market is accumulating, Look for individual assets that are also showing signs of accumulation or are leading the market in strength. If the market is distributing, look for assets showing weakness or distribution. 3. Determine if the stock is in a phase of accumulation or distribution. Focus on the specific assets chart to identify the characteristic events, PS, SCAR, ST, spring/UT, SOS/SOW. 4. Determine the stock's readiness to move. Look for climactic events like a spring or upthrust after distribution, UTAD, which often signal the impending end of a trading range and the start of a new trend. Confirm these with volume signals. Is the cause, accumulation/distribution, complete? 5. Time your entry and exit. Based on the identified phases and events, determine optimal entry points, e.g. after a spring or on a pullback, after an SOS and exit points, for example, at the top of a distribution range, or when signs of weakness appear. Crucially, always set stop losses to manage risk and profit targets based on the potential magnitude of the move, the cause and effect relationship. The beauty of Wyckoff's method is its universal applicability across various markets. In 2025, it remains highly effective for stocks, cryptocurrencies, futures, and Forex. Its focus on the underlying structure of price and the dynamics of supply and demand means it transcends specific asset classes. It's particularly relevant for the crypto market due to its inherent volatility and the significant presence of smart money entities that actively accumulate and distribute large positions. The rapid price swings in crypto often provide clearer, albeit faster, Wyckoff patterns. However, regardless of the market, the importance of asset liquidity cannot be overstated. Wyckoff's method relies on observable volume and price action that reflects institutional activity. Illiquid assets may not display these patterns clearly or reliably. To enhance the precision and effectiveness of Wyckoff analysis, it can be powerfully combined with other trading tools. Technical indicators. While Wyckoff is primarily about price-volume analysis, indicators like the Relative Strength Index, RSI, moving averages and trend lines can be used for confirmation. For instance, an RSI divergence at a Wyckoff distribution point can add conviction to a potential reversal. Moving averages can help confirm the trend direction after a breakout from an accumulation or distribution range. Order flow analysis. For advanced traders, integrating order flow insights provides a deeper, real-time understanding of smart money actions. Order flow tools can show where large orders are being placed, absorbed, or swept, offering granular detail on demand and supply imbalances that complement Wyckoff's structural view. Smart Money Concepts, SMC. Wyckoff's method forms a foundational pillar for many modern smart money concepts. SMC often focuses on identifying liquidity grabs, order blocks, and imbalance zones, all of which are manifestations of the Composite Man's actions. By integrating Wyckoff with SMC, traders can refine their entry points, identify precise areas of demand and supply, and better understand where liquidity is being targeted. For example, a Wyckoff spring can often coincide with a liquidity sweep below an old low, followed by a move into a bullish order block. Finally, no trading strategy is complete without rigorous risk management and sound trading psychology. Stop losses are non-negotiable. Always use stop losses to limit potential losses on any trade. Even the most perfectly identified Wyckoff pattern can fail, and protecting capital is paramount. Position sizing. Scale your positions appropriately based on your risk tolerance and account size. Never risk more than a small percentage of your capital on a single trade. Patience in avoiding FOMO. The Wyckoff method demands patience. Accumulation and distribution phases can take weeks or months to develop. Waiting for clear signals like a spring or UTAD rather than chasing every price move is critical. Avoid the fear of missing out, FOMO. If you miss an entry, there will always be another opportunity. Discipline and emotional control. These are the bedrock of successful trading, regardless of the strategy. Adhering to your trading plan even when emotions run high is crucial. The Composite Man profits from the emotional reactions of retail traders. Disciplined Wyckoff traders aim to do the opposite. Despite its power, beginners often face common pitfalls and challenges when applying the Wyckoff method. One significant challenge is the complexity and subjectivity of interpretation. While the principles are clear, identifying the exact boundaries of trading ranges, the specific events like springs or UTADs, and interpreting volume nuances requires considerable experience. What one trader sees as a spring, another might interpret as a genuine breakdown. The gray areas in chart analysis can lead to different conclusions, making consistent application difficult for novices. This inherent subjectivity means that significant experience and practice are essential. Merely understanding the basic concepts of Wyckoff might take a few weeks, but achieving true mastery, the ability to consistently and accurately identify patterns and anticipate market moves, demands countless hours of dedicated chart study, backtesting, and live trading experience. It's a skill that is honed over time, much like learning a musical instrument or a new language. Furthermore, it's vital to internalize that the market never behaves exactly the same way twice. While Wyckoff provides a framework of recurring patterns and principles, each market cycle will have its unique characteristics, variations, and nuances. Traders should not look for precise, identical repetitions of textbook examples, but rather seek similar patterns and context, understanding the underlying forces of supply and demand that drive them. This adaptability and contextual understanding are what separate novice Wyckoff traders from seasoned practitioners. Overcoming these challenges requires persistence, a willingness to learn from mistakes, and a deep commitment to continuous self-improvement and chart analysis. In conclusion, Richard Wyckoff's method offers a profoundly structured framework for understanding the often mystifying behavior of financial markets, and more importantly, the strategic maneuvers of smart money. Its enduring principles of the Composite Man, the 3 fundamental laws, and the 4 market phases provide an unparalleled lens through which to decode price and volume action. In 2025, as markets continue to evolve with new technologies and participants, Wyckoff's insights remain a powerful tool for identifying critical turning points, refining trade timing, and ultimately, trading in harmony with the largest and most influential players. However, successful application demands more than just superficial knowledge. It requires deep study, persistent practice, and the flexibility to adapt these timeless principles to contemporary market conditions and integrate them with modern analytical tools. By embracing this journey, traders can move beyond reactive speculation to a proactive, informed approach, mastering the art of understanding the market's true intentions. To truly appreciate the context in which Wyckoff developed his groundbreaking methods, one must look back at the vibrant and often tumultuous history of finance. Henry Clue's 50 Years in Wall Street, presented in 2 richly illustrated volumes, offers an extraordinary journey through half a century of Wall Street's past, from the panic of 1857 to the opulent Gilded Age. This memoir is not just a collection of dates and events, it's a vivid account filled with stories of legendary financiers, daring market manipulations, and the very human drama that underpins every boom and bust. It provides an invaluable perspective on the enduring nature of market cycles and the consistent strategies employed by smart money throughout history. By reading Clue's first-hand accounts, you'll gain a deeper appreciation for the patterns Wyckoff identified, recognizing how the actions of the Composite Man are not a new phenomenon, but a constant in the financial world. It's a captivating read that brings to life the historical backdrop against which Wyckoff's timeless principles were forged. Find the link to these fascinating memoirs in the description below.